Hello and welcome to this weekly market recap for the week ending Wednesday, August 13th, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to be back with all of you again today. Just a quick reminder, when I talk about the performance over the last week, we're looking from last Wednesday's close to this Wednesday's close. Just want to make sure everybody is clear about that. Here, the last couple of days, we've had an explosion higher in small cap stocks. I've talked about how lower interest rates will benefit that group. And since the July CPI report came out on Tuesday morning, I think everyone's looking at, or at least the market participants collectively, are looking at that data and saying, hey, there's no real jump in inflation. It came in as expected, and money has since poured into the small caps and into other areas that would benefit from rate cuts. And I'll talk about those later. But areas like transports, biotechs, regional banks, all of these areas are areas that'll benefit, and they've been doing really, really well over the last couple of days. So we'll take a look there. Let's first go back and check out what worked last week. And when we look at the major indices, you'll see that everything worked over the course of the last week. But no doubt Russell 2000 leading the way, gaining nearly 5% over the last 5 trading days. I can tell you most of that has just been here over the last 2 days. The S&P 400 mid-cap next, gaining more than 3%. NASDAQ 100 up a little more than 2.25%. S&P 500 up 2%. Transports up almost 2% again, coming back to life here over the last couple of days after not doing much prior to that. And then the Dow Jones Industrial Average up about 1.6, a little bit more than 1.6% last week. If we move on, take a look at the sectors. Materials gaining more than, well, almost 4% for the week. So that was your big winner. Communication services gaining more than 3%. Consumer discretionary 2.86%. And discretionary continues to power past consumer staples. That's always a good sign for the market. On the other end of the spectrum, no, the only group to lose ground last week was real estate, which did drop roughly 0.2%. Let's take a look at the S&P 500. So the S&P, you can see breaking out to new all-time highs again. The gains, again, were muted compared to what we saw on the Russell 2000 here over the last couple of days, but still S&P 500 breaking to new highs and threatening 6,500. We got to 6,480. So it seems like these 100-point increments just keep coming and going as the market continues its recent melt up. The NASDAQ 100 also setting new highs. NASDAQ 100 up just fractionally today, gaining just a little bit, 0.04%. But that comes on the heels of a pretty big gain on Tuesday. And over the course of last week, it seems like we've just slowly, steadily been making our way higher. I am a little bit nervous about some of the companies in the NASDAQ 100 simply because options expire this week. So the August monthly options expire on Friday. It's always the third Friday of the month. And as we get closer and closer to that date, just a couple of days away now, we do have to be mindful of the fact that there are a lot of in-the-money calls that are out there. And many times market makers will pull the rug out from under us, maybe have a quick little pullback. I'm not looking for anything major, but wouldn't be shocking if we saw 1 or 2% here over the next couple of days, up to maybe a week, simply because that would reduce the amount of premium that market makers have to pay out. Moving on to the IWM, and this is where that strength comes in. Check out those last 2 days. Really strong action. We had gap down back at the beginning of the month. To start the month, we tested the last breakout level around 215. If you go back earlier in the year and certainly back in 2024, this 214, 215 area served as some pretty good support. Also served as a little bit of resistance back in June on the way back up, and now served as support to open August. Since that time, we have started to move up, but really things picked up the last 2 days, and closing over 229.36 was a big deal today, because if you look back off of the highs that we saw in the 240s, that was all the way back in November of last year, when we pulled back and fell back to that 214, 215 area, we never could get back through 229.36. That was the high level that we saw. So Wednesday, today's close was the first time that we've actually been able to get through that level. So this is a big breakout. I think this sets up the IWM to go back and challenge those highs from November back in the low 240s. And recall, it wasn't that long ago, remember, that we broke out of this bottoming head and shoulder pattern that I talked about measuring up to the 249 area, 248, 249, maybe 250, depending on how you draw your lines. So I think we're on our way. This breakout was big in that regard. And I think first we've got to deal with the 240, 241 area. But if we get through that level, I think the 249 area isn't that far off. Moving on, a 10-year Treasury yield. We did fall back earlier in August, started to rise back, but then after the CPI report came out on Tuesday, you can see started to drift a little bit lower beneath that 20-day moving average. And then we saw 5.5 basis point move lower in the TNX on Wednesday. I'm watching right around 419 to 420. That's going to be a key support level for the TNX. Now, with the potential rate cuts, and I believe that's what's going on right now. I think that's why we saw such a big rotation into small caps. If you recall, we saw the same thing back in July of last year. Remember, the market got that really favorable June CPI number. And from there, over the next couple weeks, the small caps exploded, seriously outperforming the rest of the market. So we may be looking at small cap outperformance 2.0 here. Wouldn't be surprised in making that breakout. The levels that I talked about, I think that's going to be pretty key. We'll see if we can hold those support levels like 229.36, the rising 20-day moving average, those things as we pull back or if we pull back. But in the meantime, here are some of the areas that I think you've got to be looking at right now. The KRE, which is regional banks. Regional banks will do much, much better as the Fed funds rate starts to move lower. And there are a lot of folks now believing that we're going to get 3 rate cuts in the last 3 Fed meetings this year. Some are even calling for 50 basis point cuts. If we start to see rate cuts like that, that is going to benefit those regional banks. So the KRE, as soon as we got wind of that July CPI number that came in as expected, you can see it was a big, big move up in that KRE. I think that's going to continue. I believe we're going to go up and challenge and eventually get through that 64 resistance level. And I think we're making a run up for about 67 to 68 to test that November high. Very similar to what I just talked about with the IWM. Another group that has been doing very well the last couple of days really started to pick up. We saw a breakout on Wednesday, the biotech group. So the XBI, and that's not exactly the Dow Jones US biotech, because I'll show you this as well. Let's take a look at that right now. The DJUSBT, you can see also made a breakout here. It's been going up for about the last 5 days in a row. The XBI mostly has been going up just these last 2 days, but both made a breakout. So a couple of different ways to look at biotechs, and both of them showing breakouts on Wednesday. So the XBI, I think lower interest rates could spur a lot more deals in this space, and I think that's what Wall Street is starting to anticipate. With lower rates, I talked about the 10-year Treasury yield coming down. The Fed funds rate is not what's tied to the mortgage rate. The mortgage rate is more closely aligned with the 10-year Treasury yield, which did drop today. But I think the 10-year Treasury yield continues to drop because I think as inflation expectations keep coming down, I think that's going to bring the yields down. I think more and more folks will buy bonds, sending that yield lower. So, because you don't really want to be in the bonds, you don't want to be in treasuries if you fear inflation, because the rising inflation eats away at your return. So when you feel like, okay, inflation scares behind us, that's when you want to get back into these bonds, into the treasuries. And by buying those, the interest rate always moves inversely to the price of the bond or the treasury. So I'm expecting money to flow back into bonds. I think we're going to see that 10-year Treasury yield eventually move back down below 4%. I think that's going to trigger lower mortgage rates down the road. And as a result, I believe that's why we're seeing these home construction stocks do as well as they've been doing. Next up, another area to benefit from lower rates is transportation. Think about it. Transportation stocks move because more goods are going to be shipped because the economy is either strengthening or expected to strengthen. And with lower interest rates, that's exactly what the Fed would be doing by lowering the Fed funds rate. It's trying to spur economic activity. So when you start to lower rates, or when the market begins to believe we're going to see lower rates, money rotates into transportation stocks. And again, that's what we saw here over the last couple of days. For those of you that are new to EarningsBeats, I want you to go over to EarningsBeats.com. That's my home. You can scroll down. We have a big announcement coming up here over the next couple of days. And if you're in our EarningsBeats digest, you will get the news. Name and email address is all it takes. And this is a newsletter we send out twice a week, Mondays and Wednesdays. Normally it's educational in nature, could be a trading candidate, that sort of thing. We've had literally tens of thousands of folks that have joined us. There's no credit card required. There's no reason not to join. Name and email address gets you in. And then again, we got a big announcement coming. So I want to make sure everybody is on board with that. If you are on your mobile device, there is a QR code on your screen now. You can simply scan that code and it'll take you to the landing page on your mobile device and you can sign up there. All right, just a few more things and we're going to wrap this up. I want to talk about some of the individual stocks in some of these areas that are starting to see a lot of rotation. So first, in the regional banking space, here's Citizens Financial Group. This is the largest holding in the KRE, which is the regional banking ETF. Look at the AD line looking strong. Obviously, price action has been great. It really picked up again the last couple of days. And the relative strength line heading into August anyway was very strong. We've pulled back a little bit in terms of relative strength, but in terms of absolute strength, we're starting to pick back up again. I think the reason you're seeing relative strength pull back is simply because the stock is sideways consolidating. We set a top in July and we haven't been able to break back out. I think we will though. So CFG is certainly one that I would keep in mind. Another one would be FHN, another component stock in that KRE. And it also topped in just a few weeks ago in July, pulled back, hit the 50-day, now starting to move again. And once again, this has been a steadier relative strength winner among regional banks over the course of the last year. Volume trends have really picked up of late. I suspect we're going to see another breakout on FHN. So those are a couple of individual stocks you might consider as well. I talked about the home construction stocks. So let's take a look at individual stocks there. We got PHM, Pulte Home, breaking out to a new 52-week high on the AD line. Look at the price action. Very strong in Pulte. And if you scroll down, you'll see that just recently, Pulte was setting a new 52-week high relative to the home construction group. One that maybe has not been performing as well, but is starting to perform better would be Lennar. So you look at LEN, you can see again, the AD line strengthening, continuing to strengthen. This one hasn't been as robust to the upside over the course of the last couple of months, but it does appear to be picking up strength now. And you can see it's coming off of what was a 52-week relative low. The only thing I would say about a stock like this is if you see that relative strength line turn back down again and go to a new low, I would be out and I'd be looking for a different stock in this space. So the last 2 days have been incredibly strong for Lennar, but I want to see that relative strength continue. All right, how about airlines within the transports, right? Airlines last 2 days, big move up through the 20-day moving average and also to a multi-month high, closing above 230 today for the first time since all the way back in the middle part of February when the market was topping. So we got a lot of strength here of late in airlines, and especially these last couple of days. A couple of names to mention here would be maybe UAL. And I'm going to pull up a price chart here. UAL, you can see clear breakout the last couple of days. Relative strength starting to turn back up near a 52-week high. Volume trends have been great. So I think UAL looks good. Delta does not look as good on a relative strength basis, but the AD line is setting a new 52-week high. We did just get a nice breakout here, so maybe the relative strength that we've seen over the last few weeks, maybe that continues. This one's kind of like Lennar in the home construction space. I really want to see this relative strength continue. So if that turns back down and we see another relative low, 52-week relative low, then I would be looking elsewhere within the airlines. But Delta, at least on this breakout, is starting to show some relative strength. Let's see if that continues. One stock in the railroads I wanted to point out, because railroads haven't yet really broken out, done anything crazy. However, CSX, if you look at this stock, it's been doing extremely well. It's close to a 52-week high. And look at the stock relative to the railroad group. So if railroads, and you can see railroads just set a new 52-week low relative to the S&P, but if this group starts to run, just don't forget CSX, because this is the one, in my opinion, that has been the strongest in the space, and I think could really benefit and maybe get that breakout on any kind of rotation into railroads. Last group that I wanted to talk about a little bit here, soft drinks. No particular reason why I would like soft drinks in a lower interest rate environment, except some of the stocks in this group do have dividends, and as rates fall, some of their dividends do become more appealing, and that could lead to some rotation in that area. But soft drinks, you can see this past week, really strong. There is a double top that we need to watch, up between about 960 and 970. Still got another couple percent to get there, so I'm not too worried just yet. But within this space, I wanted to mention a couple of stocks. One I had mentioned, I think this was a EarningsBeats Digest newsletter stock, probably within the last month after this big move up. I think it might have been on one of these pullbacks. But anyway, I think the stock is now trending higher. It's been holding up above that 20-day moving average for the most part, and we just got another breakout. So Pepsi breaking out, I think that's good. And one other stock in this space, Monster. Monster came out with earnings, had a monster report, gapped up, went above the prior highs, has pulled back a little bit, but I think this is one, could be a leader going forward in that space. And if we pull up the relative chart, you will see that just about a month and a half ago, we were at a 52-week relative high on Monster relative to soft drinks, and it seems like we're making another push back to the upside on big volume. So those are some of the areas that I see as being potential winners going forward as the market starts to adjust to what I think is going to be a lower interest rate environment. Gave you a lot of individual stocks to think about in those areas. And now we just sit back and see how the market performs. We do have the Jackson Hole speech by Fed Chief Powell coming up on Friday, August 22nd. Tomorrow morning, by the time you get this recording, there will have been another inflation report out. The PPI is due out tomorrow morning. So we'll deal with that when that comes out. But otherwise, it looks like the market is beginning to anticipate those rate cuts into the end of the year. And I think that is going to bode very, very well for stocks, especially given how strong earnings have been coming in. Lower rates ahead should trigger more economic strength. And with the earnings growth that we're already seeing, I think this is going to result, as I've been talking about, in much higher stock prices in the fourth quarter. So we will take it one day at a time, 1 week at a time here on the show. But I hope you had a good week. I'm wishing you a good week ahead, and I'll be back next week to do it all again, recap the action, and see where we stand. Have a great week, everybody. Happy trading.